So last time we discussed some parts of financial markets. We are doing chapter 12, types of financial markets, which is topic 5 of your syllabus. We already covered the syllabus. Well, we already went through the syllabus dot points in class. We discussed sources of savings, the reasons for borrowing. We discussed the primary and secondary financial markets. Very briefly, we spoke about ASX, but we're going to talk about that in a bit more detail today. And then we discussed the 4 different kinds of markets, the 4 primary markets in Australia, and then we discussed different types of financial institutions that mainly just have to do with money, that lend money, that borrow money, that give mortgages, all of that, right? So today we're just going to look at the different kinds of financial market products. And when I say products, that basically means that the different ways that you can deal with money in financial markets by buying these products or by selling these products. And these products can be credit cards, they can be mortgages, they can be bonds and shares. A lot of it we've actually already covered. But again, consumer credit, we very briefly discussed it in class as well. So consumer credit allows consumers to purchase consumer goods and services in advance of actual payment. The most common type is called credit card, right? So in credit card, what really happens is that you basically just get a credit card from the bank, and the bank allows you to spend money from that credit card. There's always a set amount, and then you can always pay back later, right? A lot of times it works on interest, but there's some very few credit cards that don't work on interest, but that they basically have like a minimal amount that you can spend. Now, credit cards are offered by banks, credit unions, and more recently Woolies and Coles and all of that. Woolies works in conjugation with MasterCard, or it is basically MasterCard is a credit card company. Other credit card companies such as American Express work independently of any financial institution. Now, in this case, what this is really just saying is that if you get a Woolies credit card, then that basically just means that it's just a credit card, and Woolies, like it says, it works in conjugation with MasterCard, so they have a deal. Same thing with Coles as well. And you can use their credit cards to purchase things, and obviously you can always pay later, right? Apart from that, let's move on to the next slide. Housing loans. So housing loans are offered by banks as well as mortgage originators. That we've already covered that, right? Mortgage originators such as Aussies and Rams. They're basically mortgage brokers in Australia. Housing loans are generally long-term, and they're used to purchase a property. Obviously, they're used to purchase a house. We've already very briefly discussed these things before. Competition in the home loan market has actually fallen since the GFC, when banks actually took over other non-bank lenders. So, for instance, mortgage lenders like Aussies and Rams, they still exist, but many similar like them were taken over by banks. And obviously, like, for a lot of people, majority of the times, if you want to go and get a mortgage, you normally go through a bank. You don't. Very few people that I know who go through mortgage originators. Housing loans are typically higher than 1% of the RBA's cash rate. Now, again, what is cash rate? We discussed this before as well. So the RBA basically sets a rate of lending, and this we're actually going to be discussing in more detail towards the end of this chapter. A rate of lending, and then the banks basically can either lend or borrow money at a minimum amount of which is the cash rate, or they can always just charge more, right? But they can't go lower than the cash rate. So for instance, right now the cash rate is 0.25%. Because of the recession, it's very low. So banks can't charge you lower than 0.25%. It has to be 0.25 or just really more than that. Generally, it's not too high. It's normally just 1 or 2% higher. But again, there's some banks that charge you higher. Anyway, then we have business loans. It's very similar to housing loans. They're basically just loans to run businesses. They're a type of debt that allows businesses to invest in their business operations. These loans are typically more expensive than housing loans. Large businesses generally pay 1% more than housing loans, as opposed to small businesses, which pay up to 5%. As of mid-2019, Australian businesses had 950 billion debt. However, I'm pretty sure that's increased now because of the coronavirus. Okay, so that we're going to do when we do our research. After this, I'm just going to teach you. Well, you guys are going to watch this video. It's going to be part for 20-25 minutes, and then you guys are going to sit down and answer short answer questions, and then you'll move on to do some research work. And that research work will find this. Then there's a short-term money market. This has to do a lot with RBA's cash rate. That is mainly discussed towards the end of this chapter. So I'm not going to go in detail in the short-term money market. I'm just going to read the definition, but really that's about it. Okay, then moving on. So the short-term money market brings together people and businesses with temporary shortages or surpluses of funds. Those with surplus funds, such as banks, issue various forms of debt securities, such as bank bills or promissory notes. You don't need to know details about this, but they're just basically types of securities. Remember how we did we did derivatives, very similar to derivatives as well. They're basically a form of shares and bonds or whatever it is, to those in need of funds. So basically what happens is when businesses have excess fund, when they have a surplus, they can then loan this or sell this through a form called debt securities to other people or to other businesses, or really just to banks and whoever else it is that they want to. These debt securities all have a maturity date of less than a year. This is discussed later in detail, so don't worry about that. Bonds. We've already discussed bonds in a lot of detail in class, but I'm just very briefly going to go over the main the main things that you need to know. So bonds sometimes referred to as fixed income securities they're more safer than shares because you're guaranteed a return. There are longer term securities for which lenders receive regular payments known as coupon payments. Remember how I told you guys coupon bonds are the most basic kinds of bonds? So what really happens is, so for instance, Hannah, if I lend $10,000 to Hannah, we've discussed this in class a lot of times. If I lend $10,000 to Hannah and then we have a contract that says that by the end of 5 years, which is going to be the date of maturity, so 5 years for whatever time it is that you have the bond for, is called the date of maturity. So by the end of 5 years, Hannah is going to give me the money that I paid her on face value. That's the actual money that I gave her, that I lent her. That is called the face value of the bond, so the actual money. So by the end of 5 years, she'll give me the money that I paid her on face value, and within those 5 years, every year she will give me coupon payments. Coupon payments are basically just interest that you get on top of your actual money, which is face value, which you paid at face value. Hope that made sense. And again, we've discussed this too many times in class. Financial features and options are contracts to trade in financial instruments such as shares or bonds at a later date or a certain price. Very, very similar to derivatives. You remember how we discussed the example of a farmer, and the farmer wants to lend sell their cow to someone. Financial features would be a form of that. Okay, so in that we discussed that by the end of 2022, my contract with Mahim would be that I am going to buy Mahim's cows, let's say 100 cows for $100 each, right? And that is the contract. So even if Mahim's cow basically at the end of 22 are valued up at $300, I still have to buy it at $100 because that's what the contract says. Very similar to what financial features are. They're contracts to trade in financial instruments such as shares or bonds at a later date or for a price. They can also be my example was just an example of a derivative, but again, shares and bonds can also be a part of financial features. They're just different options that for which you just sign a contract to buy or sell at a future or later date. That's it. This allows investors to protect themselves against adverse movements in interest rates and currency fluctuations by agreeing to a price. So really what happens is that right now, if you know that interest rates are really low, now is the best time for you to go and have a contract with whoever it is that you want to buy products from. Because later the interest rates can increase, and that's just going to be a loss for you, right? That's what people do. Same thing for currency as well, currency fluctuations. If Australian dollar value just really falls tomorrow or like in the next 2 months, it's not going to be as useful for you if you're investing in some other country, because you'll have to change your currency to buy their currency, and that's going to be more expensive if the Australian dollar value is really low. Then the forex, we've already discussed this as well. Also called the forex market is the foreign exchange. Also called the forex market is a market for buying and selling of foreign currency. Investors and businesses require foreign currency when they do business with people overseas. The forex market provides a market for people to buy and sell currencies. Basically just a market where you just buy and sell currencies. Literally, that's it. It's open 24 hours a day, and it's just that when you import and export goods, or if you just go to any other country, we all know this. We need to buy their currency, and we need to basically buy their currency, get their currency, and buy things from them in their currency, right? Same thing with imports as well. When people import to Australia, we need to pay them in their currency. Unless you have a contract with them that says that, unless you have a deal with them that says that, okay, that's fine. I'll sell you this for Australian dollars or whatever. Okay. Then we have the share market. That's where the ASX comes, right? So the share market is a type of financial asset that provides an individual with ownership over part of a business or a company. So a share market is basically it's a financial market where investors buy and sell shares. That's why it's called the share market. So you just go and buy and sell shares. ASX is the Australian Securities Exchange or the Australian Stock Exchange. That's where you buy and sell Aussie shares. Businesses with Australian shares can sell shares in their companies to raise funds for growth. Around 40% of Australians own shares. Okay, they're very common. In Australia, a firm must be incorporated and be an incorporated business in order to sell shares. Incorporated businesses are recognized as separate legal entities from individuals who own it. So again, they're just considered to be a separate business than the owner. Okay, even if you're the owner or even if you're the manager, the business will be the business itself. For instance, for Macca's, for Hungry Jack's, for KFC, well, you should, if you're taking business studies, you should know the owners, but even then, actually, it's not too important. We know the brand as the brand or the business as the business itself. We don't really know the owners as such. So that's what this is saying. These businesses have a limited liability. So if a business fails, individuals who operate the business are protected from the risk of bankruptcy. People who own shares in a company are called shareholders. The reason that if a business fails, individuals who actually operate the business are protected from bankruptcy is one, because of the contract that you have. It depends on what kind of business it is and what kind of contract you've signed. But along with that, if you're shareholder, you've just invested, let's say if I've only just invested $10,000 in Macca's, if the business goes bankrupt, I only just lose $10,000. I don't lose my house or whatever it is, unless I've put my house in the contract. That's a different thing. Now, public and private companies. Look, with public companies, it's a lot more easier for you to sell shares because they do not have transfer restrictions. Okay, because they do not have transfer restrictions. So public companies are companies whose shares are not subject to any transfer restrictions beyond those established by government recognition. That's a different thing. And therefore, companies' shares can be traded freely in share market. That's the benefit of public companies. Because remember how we discussed deregulation? So the deregulation of the financial market mainly has affected public companies because it's owned by the government. And if the government has deregulated the market, obviously they're going to make things easier in regards to transfer restrictions. So for instance, if I buy 70% of shares in a particular company, it can easily be transferred to me. However, that's not the same for private companies. I mean, it can be the same. It depends on how private companies have to operate. Public companies do not have transfer restrictions. That's just how it is, right? And they cannot have transfer restrictions unless there can be some exceptions. But for private companies, just like private schools can operate however they want to, and public schools have to operate the way the government wants them to, right? So private company restricts ownership of shares to few individuals in places just because they want it that way. Right? So for instance, if I have a private company, if I don't want to sell it to you, I don't sell it to you. That's just however you want to operate your company. So that ownership cannot be freely bought and sold between individuals. These companies are sometimes referred to as propriety limited or PTY limited. You'll probably see that in a lot of companies. The share market only deals with the trade in share of public companies. Okay? So the share market only deals with public companies, not private companies as such. Then we've got, so this basically tells us how share market transactions are actually done. What really just happens is, what this is saying is this, okay? What happens is that if you want to go and buy share in a company, all you've got to do is just the seller, if I want to sell my shares, I need to just contact a stockbroker, and the stockbroker then registers the sale price of my company on ASX using the computer system, whatever, and then the ASX transaction is put up. Right, the same thing if I want to buy a share, I contact a stockbroker, and then the stockbroker then registers my bid price on ASX, and then that way I can buy the company. That's mainly how it works. Okay. So the role and function of share market. If you've done the ASX game in maths, then I'm pretty sure you guys know this. But anyway, investors, the role and function of the share market investors, the main aim of investors is to gain stake in company profits and to make to make capital gains from an increase in share prices. So the point is that if I'm investing in a company, my main aim is really just to get money, right? That is why I'm investing in you. So that's what the main aim of an investor is, to get some money. Owning shares also gives rights to shareholders to vote for a company's board of directors and appoint seniors. That's only if you own a lot of shares in the company. But if you own like 0.5% of shares in a company, no, you don't really have the right as such. I think you can vote, but I don't think it would be considered as a big deal compared to someone who has like 40% shares in the company. Then, dividends are basically profit returns received by shareholders on a business. So basically, if I invest in Mayana's company, and then she's just going to give me as per whatever the contract says. If the contract says that every 6 months I'll get profits for my shares, those profits are called dividends. Capital gains are profits made by investors who sell their shares or assets at a price above the level that they originally paid them. So that's capital gains would be if I had invested in Mayana's company and then I just sell that investment to Rehan. Right, that would be the capital gain because I sold it to him. Let's say if I invested in Mayana's company for $500 and I sell the exact same investment to Rehan for like $600. So that $100 is going to be the capital gain. Now, role and function of the share market, limitless gains. An increase in share value can be a gain for the shareholder, not from the shareholder, for the shareholder. Basically just means that you can gain if the company is performing really, really well, and if your share value has increased, and it always normally just increases unless a recession hits, like right now, you can gain as much. I can invest $500 and after 10 years I can make that $500 like $60,000, right? Limited risks. If a company loses its money or closes due to failure, which is happening to a lot of businesses right now, the shareholder will only lose the amount they had initially invested in the business. They do not incur any of the company losses. That's what we discussed previously as well. So if let's say, I hope not, but let's say if I invested in Mayana's company and it goes bankrupt, I'm only going to lose $500 that I invested in a company. That's it. Everything else is Mayana's responsibility. It's not my responsibility. So that's one big benefit of investing or buying shares, that you only just incur the loss of what you've invested. You don't incur any other losses. A float occurs when a company lists itself on the stock exchange and offers its shares to the general public for the first time. Is this called a float? I've put it up here just so you know. I probably wouldn't ask you that in the exam. Anyway, share prices rises. So really, what happens if the share prices rises? The shareholders are happy as the value of their investment increases. Management get bonuses and they have more job security, because if the share prices rise, that basically means that your company is valued more, and that is obviously good for you, right? And if the share prices fall, which is really sad, shareholders are unhappy as the value of their investment has decreased, they may want to replace managers because they think the business is not performing well because of whatever internal politics. Management increased pressure from shareholders, and the threat of a possible takeover may lead to job insecurity. Okay. Then lastly, we've got all ordinaries index. That's basically an index by the share market that tells you the value of different companies. So the share market values are often an indicator of an economy's economic condition. which is what we're going to get to very soon. Because market prices rise in accordance with new and better economic prospects for companies, really just what happens is if your economy is performing well, then your business will perform well, because there's nothing stopping the business from doing better, right? Like for instance, right now, economy isn't performing very well. We have a recession in Australia. And because of that, people don't want to spend more, right? Because a lot of them, there's high unemployment. A lot of them have lost their jobs. And if that basically just means that you will not be, that basically just means that no one will buy from your business. And that in turn just means that your business value is going to, the share value is just going to decrease. If the economy is performing well, everything is going really well. Right, so rising share prices will generally suggest that the economy is enjoying good conditions. By contrast, an economy that is moving towards a recession, like right now, will have fewer economic opportunities for companies, leading to lower share prices. So if the economy is performing well, more share value, more share prices. Economy is not performing well, less share value, less share prices. All Ordinaries Index is a stock market index measuring changes in the overall value of companies listed on the ASX. Now, what you guys have to do now